Hello everyone, hope you are good and be happy always. And today we will discuss credit control by central bank. Every central bank of any nation tries to control the supply of money or the credit, as we have mentioned here. Credit is supply of money in the economy. And why do they control supply of money in the economy? Because inflation and deflation are the conditions which every economy wants to avoid. So central bank is an agency which controls supply of money in economy to control the condition of inflation and deflation, to avoid the condition of inflation and deflation, and to make their economy stable. So it is the function of central bank, basic function of central bank, to control supply of money in an economy. For that, it takes two measures basically: quantitative measures and qualitative measures. So let's start with our topic of credit control by central bank. This is our code for today, BORRCS. That's a very simple code to remember, and it consists of all the quantitative measures of credit control undertaken by a central bank, and qualitative measures, the code for that is MRM. Okay, that too is very easy to remember. So let's start with our first code, that is BORRCS. B for bank rate, O for open market operations, R for repo rate, second R for reverse repo rate, C for CRR, and S for SLR. C for CRR is cash reserve ratio and S is your statutory liquidity ratio. See, I have already posted a video on functions of Reserve Bank of India. If you have any confusion regarding these topics, they have been explained in detail in that topic, in that video. Okay, so you can watch that video as well to have a clear understanding of this topic. So, what is bank rate? Let's start with the topic bank rate. What is bank rate? Bank rate is simply the lending rate of central bank to the commercial banks. See, take for example, whenever we take any loan from any bank, suppose I have taken a loan from State Bank of India. So State Bank of India will charge some lending rate or interest from me. Okay, if I have taken a housing loan, so if they are charging 10 or 12% of interest on that, that is lending rate. So in the same manner, central bank also charges interest rate on the loans that they forward to commercial banks. Commercial banks are the customers of central bank, like we are the customers of commercial banks, right? I'm explaining here. Central bank. So they give loans to commercial banks, right? Commercial, COMM for commercial banks. And commercial banks give loans to people, a general public, our customers in economy, people. So we cannot directly take loans from central bank. Central banks gives loans to commercial banks and commercial banks give loan to people. So the rate at which they give loans to commercial banks is known as bank rate, right? It is known as bank rate, and it is increased during the times of inflation so that interest rate increases. If interest rate increases, lending rate increases, commercial banks will stop taking loans or decrease taking loans from central bank, and in this manner inflation will be controlled. And during the times of deflation, this bank rate is reduced so that commercial banks take more loan and they can give more loans to general people. So there is one clue, very important clue to decrease inflation, to control inflation. All these measures are increased. I will explain them one by one. All these measures are increased. Inflation and increase, IN. They both have IN. Inflation means increase in all these rates and deflation means decrease in all these rates. I'll mention them and explain them one by one. So understand very clearly and properly. Watch this video till the end and you will be able to understand all the concepts very easily. Okay, so bank rate is lending rate of central bank to the commercial banks while lending loans to them or giving loans to them. So during the times of urgency or in need of money, commercial banks take loan from central bank, clear? And it is the bank rate is the lending rate which is charged by central bank. Next topic, open market operations. What are they? It is the process of sale and purchase of securities by central bank on the behalf of government of any nation. So normally it sells, for example, national savings certificates to the commercial banks in open market so that they can be transferred to people and they can earn some credit. Okay, so commercial banks take national savings certificates from central bank, but open market operations are increased or sale of securities increase during the times of inflation. Why? To control credit. If sale of securities is increased, I'll explain here once again. If securities sale is increased, commercial banks will buy more securities. If they are buying more securities, what will happen? They will have less money. See, when we buy something, we have to give money. When commercial banks are buying securities, they will have to give what? Money or cash. So, they will have less cash. So, during times of inflation, open market operations are increased or sale of securities to the commercial banks in open market is increased to control credit in economy. Right? Next is our repo rate. What is repo rate? It is repurchase rate of securities by commercial banks from central bank. See, during the times of urgency or need, commercial banks have to take loans from central bank, as we have already mentioned. So, what they have to do? Normally, they sell their securities to central bank, okay, and they sign an agreement with the central bank of repurchase at predetermined rate and predetermined date. Okay, so if repo rate, we are explaining here repo rate. For repo rate, commercial banks sell their securities to central bank, okay, and they sign agreement with a pre-date. For example, if the rate is 10% and date is supposed to right now it is 2020 and they will sign any date of 2021. Suppose 1st December 2021. So at this rate, the commercial banks, at the time of taking their securities back, they want their securities back also. They have sold these securities to central bank, and when they want this back, they will take these securities back by paying the amount which have been agreed in that agreement on the date of 1st December 2021 at 10% rate or at the rate agreed at the time of agreement. So it is repo rate is what? It is repurchase rate at the time of taking loans, okay? Or you can take the interest paid or the charges charged by central bank. Repo rate is repurchase rate at the time of taking loans by commercial banks. Next, reverse repo rate. Reverse repo rate is opposite of that. See, at the time of repo rate, they take loans from central bank. Commercial banks take loans from central bank. But at the time of reverse repo rate, they deposit their securities and surplus funds with central bank and they are given interest by central bank. They are having income. During these times, they have to pay. They have to pay some amount. But in reverse repo rate, banks are paid. Okay, they are paid. They are paid interest, right? They are paid interest on their deposits. Like we deposit our surplus money with our commercial banks and we are paid interest on that. Suppose on FDs or something like savings account, we are paid interest by keeping our amount in that bank. Likewise, commercial banks also get interest paid to them by central bank if they park or if they keep their funds with your central bank. So difference between repo rate and reverse repo rate is clear. Repo rate is the charge that they have to pay on taking loans from the central bank. And reverse repo rate is the interest they are given by the central bank when they deposit their funds with central bank. Clear? Okay, then CRR. cash reserve ratio. This concept has been explained very clearly in our Reserve Bank of India, the functions of Reserve Bank of India video. You can watch that, or I am explaining here also. Here, if CRR, see, CRR is cash reserve ratio. What is cash reserve ratio? Cash reserve ratio is the percentage of the deposits of any commercial bank which is mandatory to be deposited with the central bank. Suppose cash reserve ratio in our economy is 5%. It is decided between 3 to 5%, and this cash reserve ratio, or the percentage of money, has to be deposited cash. It has to be deposited in the form of cash with central bank. Central bank. Our central bank is RBI. So, if, take for example SBI, if cash reserve ratio is decided, see, it is normally decided, it is basically decided by central bank only central bank can decide it, and if cash reserve ratio is 5%, so SBI, if SBI is having deposits of 100 crore suppose, so 5% of 100 crore is what? It is 5 divided by 100 into 100. What is that? 5, 100, 0 cancel. It is 5 crore. So, SBI is left with the amount of 95 crores to create credit or give loans to people. There is one more twist we will explain in SLR now. So, CRR is clear. It is the ratio of deposits of any commercial banks which has to be kept with central bank and it is also the measure to control credit in the economy. We will explain again here. I'll explain all the topics once again. Here then, SLR. What is SLR? Cash reserve ratio has to be deposited only in the form of cash with the central bank. Now, SLR, what is that? SLR is statutory liquidity ratio. It is the percentage of deposits, gold and securities which have to be kept by commercial banks in their vaults, in their personal vaults. See, there is a small room or cabinet in every bank where there is cash, their gold and their securities is kept. Suppose for example, this is any bank, and there is a small room in every bank where their cash, where their gold and where their securities are kept. So this is vault, V-A-U-L-T, vault, or commercial bank. This is a bank, commercial bank. So every bank is having a vault with them and they have to keep their cash, gold and securities in those vaults. So this SLR, statutory liquidity ratio, is that percentage of cash, gold and securities which has to be kept by commercial banks in their vaults. It is mandatory to keep them. Why? Because to meet the day-to-day demand of credit for their customers. If all the customers at once come to them to withdraw their money, what will happen to them? So they can meet their excess demand with the help of that cash. So they have to keep this amount for safety, for security and for meeting their day-to-day transactions for their customers. So statutory liquidity ratio has to be kept with the bank, and CRR, cash reserve ratio, has to be deposited with the central bank like RBI in India. So this is clear. Now all these measures, see, all these measures from bank rate to SLR, they are increased to control credit during the times of inflation. That is, they are increased. Why? Because to decrease credit. All these measures are increased during times of inflation and all these measures are decreased during times of deflation. During times of inflation, we need to decrease money supply. Decrease what? Supply of money. Why? Because people are having excess money, they are demanding more products and inflation is going on and on. Okay, so this is very hazardous condition. This is very dangerous condition for any economy. So to decrease inflation, we need to decrease money. So we increase all these measures. Clear? Inflation, increase all these measures. And if deflation is there in economy, depression is there in economy, decrease all these measures like decreased bank rate, decreased sale of securities like national saving certificates, decreased repo rate, decreased reverse repo rate, decreased CRR, decreased SLR. This is very clear, right? Then we will move on to qualitative measures of credit control. See, qualitative measures of credit control are like advising commercial banks, the advice received by commercial banks by the central bank. Central bank advises commercial banks to take necessary steps to avoid the condition of inflation and deflation in their economy, and this is known as qualitative credit control. This is subjective. They advise, central bank advises to all the commercial banks operating in any economy. So first qualitative measure is margin requirement. What is margin requirement? See, whenever we take loan, we have to pledge something or we have to mortgage something. We have to keep something with the banks as security. So security we are offering and the loan we are taking. That is the difference. Margin requirement is the difference between them, security and the loan amount. Okay. So if I have a house which is worth rupees 10 crore, right? 10 crore. And if I am asking a loan from government, and if credit margin requirement is 20% and 20% of 10 crore is 2 crore. So if I have to take a loan of 8 crore, I'll have to pledge something of 10 crore. If I am pledging my house, mortgaging my house of 10 crore, I will be getting loan of how much? 8 crore only. If margin requirement is 20%. It is a measure to control the capacity of taking loans of people. If during times of inflation people are taking loans, this margin requirement will be increased by the banks so that people are discouraged to take loans. If see this margin requirement is increased to 30%, what will happen? By giving a house of 10 crore, we will be getting how much now? Only 7 crore. If this is further increased, if this is increased to 40%, then we will be getting only 6 crore rupees in lieu of a house of 10 crore. So this is how it works, a margin requirement. That is rationing of credit. See, agricultural sector in India is a priority sector. So rationing of credit is done to direct money towards some of the priority sectors like small scale sector in our economy, agricultural sector or the needy sectors in our economy. So rationing of credit is advised by central bank to the commercial banks so that they direct their credit or give credit to the needy sectors of economy so that whole economy can be stable and it can prosper and develop. Suppose quota of commercial bank that has to be given to agriculture sector is 20%. So 20% of the loans would be forwarded, they are fixed for agricultural sector. In the same manner, if 40% of the loans have to be given to industrial sector or small scale sector, they can be forwarded only to industrial sector. So in this manner, quota of credits that can be forwarded to sectors is fixed by the central bank by rationing of credit. Like we have public distribution shops or ration shops, in the same manner credit is also rationed. See, credit is forwarded to the needy sector and it is given to the sectors which are requiring help in any form. Then moral suasion. This is a form of advice to commercial banks. In this measure, moral suasion, central bank only advises the commercial banks so that they take necessary measures to control inflation and deflation in economy so that an economy does not become unstable and cause problems for everyone in economy and the government as well. So these measures, quantitative measures, BORRCS, bank rate, open market operations, repo rate, reverse repo rate, CRR, SLR are the measures which directly influence or directly cast an impact on the credit or supply of money in economy and qualitative measures cast an indirect impact basically, but both have important role to play in credit supply in economy. And during the time of inflation, all these measures are increased to decrease supply of money during the time of inflation, and during the time of deflation, all these measures or percentage of these measures is decreased. For example, during the time of deflation, CRR can be reduced to 3%, so that banks have more money to give credit to people, and people demand more commodities in market, and in this manner businesses in the economy prosper. So that was, I think, quite clear and loud to you people. BORRCS is code for quantitative measures, and MRM is the code for your qualitative measures. If you have not understood anything, you can clearly and easily write to me in the comments box, and I would be more than happy to explain it to you people. And thanks for watching the videos, thanks for subscribing and liking the videos. Thank you so much.